Good evening, guys. Tonight we are on episode 6 of Beginner Training Mentorship, and today we're seeing one of the most important concepts ever, which is what is a fair value gap. So today we're going to go a bit more into the theory part. I'm gonna teach you the setup to trade this in the next video, but I'm still gonna show you in this video a trade that I took today, which was based on fair value gap. Okay. So please take notes. You're gonna get confused in this video, that's really likely. So if that happens, no problem. It's exactly what should happen. It means you are paying attention. So you write me in the comments, or and I'll try to clarify. If it doesn't get clear, it's not a problem. It will with time. I already said this in an answer to one comment. Okay, so let's start. What is a fair value gap? It is a place in the chart where price is attracted to because it has not been traded at since it has been created. Okay, then I'm gonna show you what this means. So price will usually, why is it useful? Because price will usually reverse when it reaches this fair value gap. And so the upper value gap is a three candlestick formation in which the second candle is an imbalance candle. This means that the second candle is a really strong move without much contrast. Okay, so here we have two examples of what is a bearish fair value gap and a bullish fair value gap. Okay, so as you see here in the bearish example, these are the three candlesticks. We see the second one is really strong, and this part right here, so we're gonna do this after. As you see, there is a place in this candlestick which has not been covered by these wicks. Okay, so to understand where the fair value gap level is, you just do this. You take this, the low of the previous candlestick. Okay, I'm sorry. You take the low of the previous candlestick, the high of and the next candlestick, and you draw this. Okay, this is your fair value gap level. So with fair value gap, we write this FVG. This is your fair value gap level. So what you want to look at, you want to see the price doing is like this. Okay, so maybe price just keeps going down a bit. Okay, like this, and tests fair value gap, and then goes down again. Okay, this is what you would look for. Instead, in the bullish example, as you see, this place has not been covered. So we do the same thing, but the opposite way. We take previous candlestick high, next candlestick's low, connect them, and get this, which is our fair value gap. We would look for price doing this instead. We would look for price higher, then reducing back here, coming up, down, and then up. Okay, that's what we would wait for. So this is what a fair value gap is. Now let's go into the chart and I'll show you the trade I took today for basing myself on that. So on the day we were absolutely bearish. We were bearish. We were looking to go down. So on the 50-minute chart, this is where the market was going to open, 8:30. Okay, New York time. As you see, we had a fair value gap right here. I'm gonna take you through this. So we have this place of the candlestick which has not been covered. So what do? We get this rectangle from this low to this high, as we said before. So we had this entering the market at 8:30. The market opened. Go down to the 1 minute. We can look at it this way. Okay, we see market opens, reaches the fair value gap a few times, creates a short-term low about right here. I'm gonna draw it for you. This one. Then price breaks through this low, traces back. That's when we enter short. We put our stop loss a bit, broad because price it was just when we entered it was just 944. Price is still really volatile. It means it moves really quick and a lot. So our stop loss needs to be wide. And our TP near an important zone. You can't just put it below the important zone because it's a lot likely that it won't get hit. So this was the important zone we're talking about. If you just put it below here, you would get to stop loss. Instead, you need to put it just near. Okay, so you have this, and that's what we took. So if we were risking $100, we would have made in 62 minutes. This trade took a bit more than usual. 62 minutes. We would have made just about 200 US dollars. So this is not bad. You just needed to start the trade, then you go eat your crisps and do your homework, sleep a bit, whatever. You wake up, you got this. Okay. So this was the example using fair value gap logic. As you see, we can also say that there was a bit of the logic we studied, you should have studied in the previous lesson, which is liquidity sweep. Why? Because we had also um this nearly equal highs, I think, right here. No, not really. Yeah, maybe a bit more like this. Yes, exactly. So you see, up here there was buy side liquidity. Took out the buy side. This was even a better setup. Took out the buy side liquidity. Got down real quick. So I hope this video was helpful. I know you are confused right now. It's not a shame to write me in the comments. That's the best thing you can do for you to be profitable. Okay? So please take your time to study this. Write me in the comments. I can make as many videos as you want for this. This is a so important concept. So in tomorrow's video, we're gonna revise this. We're gonna tell you how do you take such trades and make such money. Okay? So that's all for today. See you tomorrow.